Happy Thursday, everybody. Welcome to another show featuring LEARNin 1031 Live. My name is Chris Astillero with Exchange Resources. Welcome to our show. All right, everybody, welcome to 1031 Live. We're here. We're going to have another amazing show, some great information for all of you who are investors. We have the illustrious Erica Traulsen with Legacy Investments in Real Estate. Erica, how are you?
Hey,
great
Chris.
to see you.
I'm doing so well. Happy Thursday. You caught me grooving to that music there when I
love it. It gets better and better every time we have a show, right?
Yeah,
thank you to our producers.
Yeah, I know. They're amazing. Well, hey, everyone. We have a really great show for you today. We are going to be talking about debt replacement in your 1031 exchange, which is very important. But before we dive into that, why don't we hear a quick word from our sponsor?
Bernardo, we've been around for over 26 years and we've done over 60,000 tax deferred exchanges. If you don't do a 1031 tax deferred exchange, you could be faced with about 30 to 40% in taxes, right? Wouldn't you rather roll that over to the next property so that you can buy more with it? Well, we're here to give you your options. Let's talk. Oh my God, Erica Traulsen, they do such a great job with, with the sponsors. It's so great. I love it.
I know, I love it. It was like, you were like even moving there at the end.
I know, right? Right. Great to have you though. Always great to see your beautiful smile and, you just make my day every time I see you, because we're talking about opportunities for investors, and you are the professional, you are the expert of DSTs, and it's so great to have you on our show. And today we have a very special guest.
We do, and we're gonna be talking all about debt replacement today, as I mentioned. So rather than me introduce him, Casey Clayton, welcome to our show. Why don't you tell everyone here who you are and your experience with 1031s?
Yeah, happy Thursday, everybody, and thanks for having me, guys. I'm Casey Clayton with Cross Country Mortgage. Got 10 plus years in lending and real estate investing. So I've been through the 1031 process on both sides as a lender and as an investor. So I think there's a lot of great insights I can bring and just really happy to share that with everybody today.
Thanks, Casey. Thanks for joining us on our show today.
Of course. Thanks for having me. So next time we'll do it over some wine, Chris.
Well, I've got plenty of wines here to share.
Wow. Where are you?
University Club. I'm at the University Club at the wine room.
I don't think I've been in that particular room before.
It's a really nice room if you really want to drink lots and lots and lots of wine.
Yeah. VIPs only, right, Chris? While you're in there?
You're a VIP. You're a VIP, right? Come join me next time.
So today, you guys, I love that. Love that idea. Today, though, Casey, we invited you because we want to talk about replacing debt in a 1031 exchange. And who better to talk about debt replacement than a mortgage expert? But before we dive in and ask you some of these questions, Chris, question for you.
Yes.
I frequently get phone calls from people going, I have a $500,000 capital gain, so that's what I'm going to reinvest in my DST, in my 1031. And I'm like, whoa, okay, pull back a second. First of all, what's your cost basis? Do you have any debt and your $500,000 of gain? So tell our audience really quick about the requirements for the 1031 exchange value.
Absolutely. So one of the rules with the 1031 tax deferred exchange, and it's been around for over 104 years now, is that one of the rules is the investor has to roll over all of the cash and all of the debt into the next property, which means if you have a $1 million property that you're listed, that you're selling, and you have a $500,000 gain, but you also have a $500,000 loan, that $500,000 gain, to be fully tax deferred, has to be rolled into the next property or properties. And then the debt of $500,000 also needs to be rolled over into the next property or properties. Consider that $500,000 debt as cash. All that cash, the $500,000 loan and the $500,000 in gain, all have to be rolled over. If you don't roll over that $500,000 loan, it's called mortgage boot. Because if you don't replace that mortgage at the close of escrow, you're going to get a $500,000 check, right? So you have to replace that so that it's fully tax deferred. And, it could be anywhere from 30 to 40% in capital gains tax, if you don't roll over all of that, all of the cash over to the next property.
Thanks for clarifying for everyone, Chris.
Yeah, that's great. And I'm really excited to be here. Obviously, I can give a lot of perspective on how to roll over that debt when you're going into a new investment property.
Yeah.
But before I dive into that, Erica, being the DST specialist, why don't you let everyone know how debt works and debt replacement works through a DST?
Thanks, Casey. So for those of you who haven't met me before, Erica Traulsen with Legacy Investments and Real Estate, and I am a specialist in working with DSTs, which are Delaware Statutory Trusts, which can be, for accredited investors, a wonderful solution for kind of the estate planning phase for many people for their 1031 exchanges. Maybe you want to get out of the toilets, trash, and tenants and into something totally passive. So because of that, these investors can exchange their property by selling whatever their investment property is, going through the tax deferred exchange using exchange resources, Chris Astillero. And then when you go into a DST, if you need debt, some of these DSTs have a debt amount, a loan to value on them. They're already like part of the DST, part of that physical real estate property, so that our investors have it built in. It's built in, it's baked in to the investment itself, so that you don't have to go out and acquire a new loan on your own. Let's say you have a 53% loan to value. We're going to be looking at DSTs with a 53% or higher loan to value, so that it's already taken care of. You're not going out and getting a mortgage on your own, especially if you're living on a fixed income. That could be tougher for some folks. So it's honestly very easy. And we do encounter some folks that aren't able to get a loan on their own. And this could be a great way to take care of that.
Yeah, that was great. I honestly didn't know exactly how that worked. So I even learned something right there. So that's awesome. It's
pretty neat because some people have like a kind of a funky loan to value, I'd say, maybe they only 5% left. And, they're not really going out and acquiring, inquiring for a new loan with a 5% down on a new property. We can put them in, do a couple different DSTs, create a portfolio, and either leverage them up if they want to, or put a tiny bit into a 0% loan to value DST and the rest into a DST with a higher loan to value, and make those numbers work out for them. They don't have to acquire more, but we know they can't go down in debt. So unless they're replacing it with cash, right, Chris? You can replace your debt with cash in a 1031.
Yeah, they can replace it with their own cash, right? They can replace it with a new loan, or they can get seller carryback financing. But if they're going to be doing DST, then obviously if there's already debt on there, like say for example, it's a $300 million property and there's $100 million worth of debt, potentially the investors can acquire that pieces of that $100 million debt. Is that what you're saying?
Yeah, their percentage ownership. If you go into a property and you become a 1% beneficial, you own 1% of the beneficial interests of the DST. You also acquire, it's not on you or your credit report or anything, but you are it's allocated toward your debt replacement needs. So you have 1% of the equity, you also own 1% of the debt that's on the DST.
That's fantastic.
Casey, we'd love to hear though, what kind of, what happens? How do you work with clients who need a debt for their 1031 exchange?
Yeah, there's a variety of ways we can help them, everything along the spectrum from conventional financing that you kind of touched on, where we take into consideration their personal income and liabilities, where that fixed income piece that you mentioned would be important, all the way to the other end of the spectrum with hard money. But I think the sweet spot and one of my favorite products for investors is the DSCR loan. So for those of you that aren't familiar, it's debt service coverage ratio. And essentially all that means is we are qualifying the borrower based off the property itself, and we're not taking into consideration any of their personal income or their personal liabilities. So very high level, if the rents on the property cover all of the debt plus basically PITI, so principal, interest, taxes, insurance, that is the main qualification for the loan. There's a lot of other benefits that come with it. In a lot of ways, it's a lot easier to qualify for. But I could go on forever. Let me know exactly what you guys want to know about it, and I'll give you all the specifics.
Well,
Go
ahead, Chris.
Casey, so when it comes to these investor loans or these DSCR loans, what sort of interest rates are you looking at? What sort of terms are you looking at? Are there prepayment penalties? Can you just kind of go over that so that our viewers understand what type of loans these are and what kind of interest rate that they expect?
Yeah, I think you'll be really surprised at how good some of these interest rates can be. So with the DSCR loan, there's really 4 factors that are going to affect the rate. There is the loan to value, and there's the credit score of the borrower, which is pretty standard across most loan products. There is that debt service ratio and how strong it is. So the more your property cash flows, the better the rate's going to be. The less cash flow in the property, the higher the rate. And then the last piece that you touched on is the prepayment penalty. So it varies by state, but in most states, you can do anywhere from a 0 to a 5-year prepayment penalty. And the longer the time frame, obviously, the better the rate. So when we're looking at, a well-qualified borrower with a decent down payment, good credit, a lot of times coming through a 1031 exchange, there is a lot of capital gains you have to roll over. So we're going to be looking at some lower loan to value loans, and they typically get some really good pricing that way. You can get rates that are competitive or better than conventional financing. I mean, we've done some in, the low to mid 6s with a 5-year prepayment penalty and a low loan to value, all the way up to, maybe mid to high 7s for somebody that wants no prepayment penalty and, maybe the property isn't cash flowing or is very tight. So a wide range depending on those factors. But, for the well-qualified people coming through the 1031 exchange with that down payment, you're probably in the mid 6s, which is just right on par with conventional financing right now.
Fantastic. Thanks, Casey.
Is there a specific coverage ratio that you are, hoping to see, or how does that?
Yeah, I mean, basically 1.25% is where you're going to get the best pricing with most lenders. Anything 1% and over, and I shouldn't say percent, but 1 to 1 essentially just means you break even, right? So the rent covers principal, interest, tax, and insurance. And if you break even, that's 1 to 1. Anything 1 to 1 and above, you're going to get pretty good terms. What also surprises a lot of people is we will do ratios down to 0.75. And so you don't have to have positive cash flow.
Really?
Yeah. So there are products that will just allow you to close with, negative cash flow. And then there are products that also allow you to use some of your other assets. We kind of call them like hybrid DSCRs, where we can almost do like an asset dissipation if you do have other cash or retirement accounts to bridge that gap to get the ratio up, just to help with the pricing. That's not really needed to qualify, but if we can combine those two, we can get you better pricing by doing that.
Is the idea with the negative cash flow during closing that they will be increasing cash flows, hopefully going forward? Like if it's not fully occupied, or what's the thought?
It can be fully occupied, with the negative cash flow. The idea is more talking about the investment strategy. They might be, investing for depreciation or future appreciation, and they're not really worried about the monthly cash flow. That might not be their primary goal. And, obviously from the lending side, there's more risk that way on our end because obviously the property doesn't cash flow and we're qualifying off of the rents. But that's where that second piece comes in, where we can look at their assets and, find ways to bridge that gap if needed just to help out with the pricing. But even if we don't do that, we can still close them down to 0.75. And the goal is more appreciation, depreciation, and, other strategies that are used in real estate outside of cash flow.
That's fantastic.
That's a really good point.
What states do you finance? Sorry, go ahead.
Sorry, I'm not sure if I'm delaying sometimes, but it's great to hear you talking about that because the majority of my clients, probably 98% of them, are coming to us looking for cash flow. So that's not something I'm typically thinking about like someone negative cash flowing and that being okay with them. Most of my folks are coming to me, the majority in their retirement years, looking for just steady, stable income for the most part, and looking for diversification and things like that. And the negative cash flow is something they would never entertain. That's really interesting to hear that. Really cool.
Yeah, I mean, the different clients, right? Like a lot of clients use real estate as a vessel to offset their income taxes. So depreciation might be their primary goal in a purchase, and they don't really care about the cash flow because they're still working. They're not your retired client. They've got all this W-2 or self-employed income and are looking for additional write-offs, and that's their primary focus. But at the same time, they also want to, kind of trade up and roll into a bigger investment where they can get more depreciation, right? That's where the 1031 comes in, because you start to depreciate your asset and you need that depreciation to offset your income on your taxes. So then you need to go trade up and get into a bigger property as you're trading down your depreciation, so you get more to offset more income, essentially. So just a different strategy. Go ahead.
2 questions for you. Number 1, what states can you finance? And number 2, do you see a lot more investors moving out of the state of California because they're not seeing a significant rate of return that they're seeking? And can you tell me what sort of states that they're going into?
Yeah. So I can lend in all 50 states. So that's the great thing is at Cross Country, we're licensed in all 50 states. So even states that require a license, we're able to lend in on the DSCR or conventional if the borrowers choose that route. As far as your question, that goes back to the borrower, right? Like we do have a lot of borrowers that are staying in California because of the high price points and getting the additional depreciation and appreciation. For borrowers that are looking for cash flow, we're seeing a lot of them move into the Midwest and the South. So I'm seeing a lot of Ohio. We're seeing Tennessee, Georgia. So they're looking for places, 1, where they can get better cash flow, and 2, that they're getting, better landlord friendly laws that we don't quite have here in California. They tend to skew on the tenant side here. So those are the 2 big things for people moving out of state. 1 is cash flow that you mentioned. 2 is more landlord-friendly states.
That's fantastic, Casey. And for all of us who don't know, how long have you been in the industry, and what sort of lenders have you worked with before? Direct lenders, brokers? Is your company right now a mortgage broker, a direct lender? Yeah.
So I've been doing mortgages for 10 plus years. Started my career at Wells Fargo, so very corporate. Didn't do DSCR loans, very conventional jumbo only. But I still work with a lot of those same clients because I worked with the private wealth group at Wells Fargo and worked with a lot of high-end, high net worth clients that also invested in real estate. So now at Cross Country, we are a direct lender. We have a lot of in-house fully delegated products. We do have a broker channel if needed, but for the most part, especially when we're talking DSCR, we're able to keep everything in-house.
Perfect.
Is that your preferred kind of loan in a 1031 exchange? Or
100%.
people looking at others?
Yep. People are looking at others. And what's crazy is I feel like for the experienced investors that truly are doing real estate investing as like maybe their primary income, or they've just been doing it for a really long time, they're familiar and they prefer the DSCR loan over other loans. But for a lot of your more novice investors, or the ones that are just, hey, I have a couple investment properties here, it's an investment strategy, this isn't what I do for my day job, they don't even know this loan exists. So I really love getting on shows like this and talking about it and just spreading the awareness. One of the things we haven't touched on is the ability to close in an entity. So there's people should be closing their real estate in an entity, not a lawyer, but my personal opinion, right? You want to protect your personal assets. So the DSCR loans allow you to close in most entity types. You can close in a trust, but more importantly, you can close in an LLC, a corporation, a partnership, a limited partnership, et cetera. There's not very many restrictions on the entities that you can close in. So on top of being able to get good terms, on top of being able to qualify easier, you are also getting that additional protection from having your assets in an entity and separated from your personal assets.
Yeah, that's a really great point. for a lot of the DSTs that we see, not all of them, but many have a Fannie Mae loan. And I don't frequently, but I sometimes get asked from investors, what is the DSCR? What is the debt service coverage ratio on the property? So I was somewhat recently working with a client who is actually a young investor. I think he's like 33, 34. And it kind of surprised me that he asked this, but we were comparing two different multifamilies. He was going into two investments. We had one with an industrial over here, and we're picking out the multifamily DST. And he said, well, you know what? Will you grab the DSCRs on those for me? And I said, sure, give me a minute, because they've probably been updated since the PDF came out. And I, just out to all of the sponsors and was like, hey, I need you to find this out for me. And some of them were quite surprised that I bothered asking. But for him, it was important that there was a high debt service coverage. Sorry, my speech is a little funky today. But it's just been a long week. We're only on Thursday, right, you guys?
It's basically Friday.
It's basically tomorrow's Juneteenth.
Yeah. So you get a pass. It's Friday.
Thanks. It's Friday today. So yeah, we can get that information, for people who are interested. And in this case, this investor kind of based his final decision on that, because the multifamily DSTs in this case were pretty similar loans to value, good quality sponsors, lots of experience in the space, longtime sponsors, and it was what do we do? Flip a coin? And he ended up asking about that. So there were some in that 1.2, 1.3 range. There was one that was kind of outlandishly larger and growing. So that was a determining factor for him. But, it isn't the first thing that we're looking at when we're talking about what DSTs to put in a 1031 exchange, portfolio, especially if they're looking for diversification and everything. So this is really neat to hear about it from your side, the individual or smaller entity investors.
Exactly. And yeah, if your clients are really focused on cash flow, it is a good tool to look at, because it is going to give you a good idea of comparing cash flow across properties.
Casey, what happens, and sorry if you talked about this at all already, but I had to dip out for a second, reset everything. But what happens if the coverage ratio isn't met?
Yeah, so talk a little bit about it, but we will go down to the 0.75.
Right.
So it doesn't have to cash flow. If you're still not meeting that, there are the hybrid options where we can look at your personal assets and kind of do like an asset dissipation qualification, where we give you an income number based off of the assets to offset that negative. And then I didn't really touch on this, but there are also no ratio products. We're kind of getting into the realm of a 30-year fixed hard money loan when we go to the no ratio product. So it wasn't something I was going to spend a lot of time on. But if you have an investor, I know with the 1031, you're on a time crunch. If they need to get something done, we do run into cash flow issues, there is a no ratio product as well. But rates are much higher. Down payments requirements are higher. Like I said, we're kind of getting into the hard money space, but the biggest difference is it's still a 30-year fixed loan versus, a short-term hard money loan they'd have to pay off in the near term.
Perfect. A quick question for you, Casey. Compared to last year, do you see an increase or decrease in investor loans? And also, do you see an increase or decrease in families who want to own properties as their primary residence, those type of loans?
Yeah, I don't know about year over year specifically, but I would say over the course of the last, 2-3 years, as interest rates were higher and they're starting to come back down, we're seeing a lot more investor activity. The investors are really picking up. And then on the first-time home buyer or just the primary residence side, I feel like that has slowed down a little bit, but year over year, that's picking up. So, that 3-year, it slowed down, but we are picking back up this year. I think people are just kind of at the point where they understand where rates are. They understand if, they want to buy, that this is something that isn't going back to 3% or even 4% in the near future. So they've kind of accepted that, and we've seen some more people come into the market because of that.
Yep. And it seems like you have a lot of different loan programs that are very creative that can actually get people into their homes as a primary residence and as an investor. So it's good to know that they have all of these options to just get into that property, especially here in California, where appreciation has gone up significantly. And for the most part, a lot of investors are really not looking for the cash flow. They just want to get in and then ride on that appreciation. And once they get that gain, then they can go ahead and do a 1031 into other properties, possibly out of state, and buy maybe 2 or 3 properties where they're cash flowing.
Yeah. Definitely see when people go out of state and they've built up that equity, they kind of go into the multifamily space, right? So they'll buy a property here in California, build a bunch of equity, and then they'll start looking for 4, 8, 16, sometimes even, larger multifamily in some of those other places I mentioned, Ohio, Tennessee, Georgia, are kind of the big ones we see.
Yeah.
But
and then
I think real quick, that's one important thing to mention with talking DSCR, is it is primary a residential loan. So 1 to 4 units is the sweet spot. We have a lot of lenders that will go up to 10 units on it. But once you get over 10 units, we're more in the commercial space, and you're more looking at a commercial loan than a DSCR loan. And one cool thing that we do at Cross Country is we will do them on mixed use properties that are primary residential. So if it's commercial at the bottom, 1, 2, 3, units, residential above, mixed use, we can use a DSCR loan on that as well.
Good to know. Good to know.
Yeah, that's folks who don't want to be dealing with all of that or going into other states, get out of California, maybe look at higher cash flow and don't want to get hands-on on their own. That's who does end up calling us and going, hey, get me out of California, diversify me, put me somewhere else. I'll be in DSTs and not lift a finger anymore besides to push forward on my keyboard in my email to send my tax docs to my CPA. We don't have a ton of time left, so I kind of want this. Let's get in one last tip from you, Casey, or some bits of info. I guess this is more of a just let us know what happens. So what happens if the person on the loan passes away during the holding period of that piece of real estate and the DSCR loan? So do they?
Yep.
Yeah.
It's a loaded question because it really depends on the entity structure and how it was set up initially. If you're in a corporation or if you're in an LLC, we're going to go back to the operating agreement or the corporate structure and see how that reads, right? Some operating agreements will say, hey, this passes on to the heirs. Some will say once one party passes, all of the interest goes to the other party. So it's really going to depend on how the entities are set up, a little bit more so than how the DSCR loan is set up. But we won't call loans for death. So that's the important piece. If someone passes away, we're not going to call the loan due. We're going to get those entity docs. If it isn't in an entity or if it's in a trust, we'll get the trust docs and we'll see who the responsible party is and, give them access to the loan moving forward.
That was a really good point there, Casey, because, people are afraid, that loan may be called and they either need to refinance or, if they can't qualify, they may need to sell the property. So I'm glad that you brought that point out, that you don't call the loan, that you actually look at all the documents before,
And for people that, are looking to pass this along as an inheritance, as long as that's properly put into the documents, then there's no issues doing that. Your heirs can take the property. It just has to all be set up right on the entity side.
Fantastic.
Good to hear. Well, guys, any last thoughts on this very informative 1031 power half hour?
No, thanks again for having me, Chris. I know you're the 1031 guy, so anything else that, any last questions for us or any last comments from you, love to hear them.
I think this is great because we were able to talk about the financing and then the debt replacement, especially on the DSC side. Thank you so much, Erica Traulsen, for clarifying that. Casey, you just did a great job, just clarifying all the loan programs that are available. And for a lot of people, they don't know. And so that's why I think this show is important, so that they know that there's creative ways of getting into that real estate. So thank you so much for being on our show today. Casey, Erica, have a great Juneteenth. Have a great weekend with your families. I wanted to remind everyone to please log on to school and become a part of the community so that we can continue to grow and share, create content for all of our viewers. So thank you all so much for joining us. Happy Thursday. And thank you for watching LEARNin 1031 Live.